Good day, guys. Welcome to the investment analysis. Our case study today will be social media companies or ad-based platforms. These are platforms that provide a free service to its users and generate revenue by selling data generated on these platforms from their users to advertisers. Now, the first company we'll be looking at is Meta, the company formerly known as Facebook. It changed its name. It went through a bit of a corporate change. Now, this was basically to signify that it's no longer just a social media company. It is more of a diversified tech company. To a degree, it is true. I mean, it does have a diversified range of services. I mean, the bulk of its revenue still comes from ad-based revenue. However, it is diversifying slowly but surely into other areas. For example, streaming, commerce, as well as gaming, and of course, hardware in the form of its metaverse, Oculus, what is it, goggles. Uh, but before we start with the analysis, I just want to draw your attention to a little bit of background information of how the analysis will operate. Now, before you do an analysis, there are three main areas that you will need to research. And this analysis that we did on this case study, we did three. We basically researched three main areas. Now, these areas are financial performance, growth and profitability, financial position, which is the strength of the balance sheet, as well as liquidity, the ability of a company to generate cash flow from its operations. Now, these three elements are very important because they will help you justify an investment as well as justify a valuation. Okay, more background. All the financial information, the financial statements of each company was obtained from the relevant company's investor relations website. And we will be looking at mainly three financial periods, which is 2018, 2019, and 2020. This is for all the companies in this industry. Furthermore, 2021 is not yet available. The financial statements have not yet been published, but probably be published in February of 2021. February of 2022, sorry, February of 2022. I keep forgetting that we are in 2022. February of 2022, that's when they'll probably be published. One last background point, please bear with me. Net income or net profit. Now, for net income or net profit, I prefer to use the net income or net profit, depending on which term you use. They're basically the same thing, net income, net profit. Same thing, just different terms. I prefer to use the net income before taxes. Why? Because taxes are very unique to each other, and the relationship between income and taxes are exclusive. Because just because you make income doesn't mean you're gonna pay taxes for these tech companies. I mean, a lot of them make billions and billions of dollars in profits, but virtually pay minimal to no taxes, and that is because of the legal complexities of the taxing codes that provide companies with legal loopholes to pay no tax or very, very low tax. So that tax relationship creates a bit of volatility and distorts comparisons a bit. So that's why I prefer income or net income before taxes. Okay, enough of the background. Now let's get into the meat of the case study. First company, Meta. Now, looking at Meta, first we'll be looking at its financial performance. So that's growth and profitability. On the growth and profitability side, we start off first with net income margin. Now, this ratio in a nutshell is basically the ability of a company to turn revenue into profit. So with Meta's case, for each dollar of revenue it generates, it's able to convert that dollar on average into 40% or 40 cents of profits. The margins have been fairly impressive. I mean, slight deterioration in 2019, but a massive bounce back in 2020. Now, any deterioration of margins can be accepted, considering the industries companies operate in. They do need to spend heavily on R&D costs as well as other costs relevant to its infrastructure and IT services to host this platform. So you do not mind to see a bit of a deterioration, but any deterioration should not be sustained or prolonged, and all those costs incurred or the increase in costs incurred should be justified in the form of increased revenue and profitability. So we knew the duration was slightly due to the fact that there has been a bit of an increase in costs. Okay, now looking at costs, what I do like from 2018 to 2020 is that cost of revenues have been increasing, but you can see they're increasing at a slowing or a decreasing rate. I'm happy with that because it shows me cost control. Yes, the entity is decreasing costs. Yeah, they are growing, but it's at a slowing rate, so they're controlling costs. So they're not growing or spending for the sake of spending. They're spending for the sake of growing. All right, we're gonna get to the growth in net income and revenue pretty soon. The growth in R&D has been growing at an upward trend. I do expect that because I mean this industry is very R&D heavy. To innovate, you need to spend on innovation, basically R&D. Sales and marketing, pretty of a bit of a minuscule expenditure because it's been pretty stagnant on average on 14% over the past 2 years. So happy with that. That tells me cost control. Uh, Research and development has been, as a percentage of revenue, has been increasing at a upward trend, more or less in line with the industry. Again, very happy. Again, very happy. I want to see increase in R&D. I do want to see increase in R&D, but it needs to be justified. Just because I'm seeing increase in R&D does not automatically mean that I am happy. It needs to be justified. Now, are all these cost increases, have they been justified? Yes, they have been, in my view, because you look, revenue has grown by a compound rate of 29% over the past 3 years. Decreased a bit in 2020, the rate, of course, but I'm still happy at where Meta has kept their revenue. That to me as an investor shows me stability, shows me that even though there has been up increases in costs, those costs have been justified. So they're not growing for the sake of growth, they're growing for the sake of profitability. Net income justified by the fact that revenue has been increasing steadily. Some costs have either been stagnant or increasing at a downward trend, leading me to a beautiful 13% compound growth over the past 3 years. So, am I happy with Meta's profitability? Yeah, I'm happy. You know, the company generates what, 85 billion. This is billion. You know, remember all these financial figures are rounded off in millions. So on that 86,000 is times a million. So that will give me $85 billion worth of revenue generated in 2020. That is very good. It generated 85 billion, but with that 85 billion, it still managed to grow net income at 17% and achieve a pretty strong margin of 39%. So it managed to grow revenue, but turn that revenue into profits. Happy. Good cost control. Costs that are spent are justified. So the good margins are driven by good cost control as well as increase in revenue. And costs that have increased, R&D as a percentage of revenue or R&D growth, they have been justified. So I'm happy with that profitability. Now again with return on equity. Return on equity, it's a profitability measure, but more importantly, it tells you how efficient a company is or how efficient a company has been in turning shareholder capital into returns. happy with this because the S&P 500 over the same 3-year period on average returned about 13%. Meta over the same period returned an average of 27%. So I am more than happy with how Meta has been using shareholders' equity. Now, this is a good indicator of the fact the company is productive and efficient in the use of shareholders' capital. Now we're moving on to financial performance. Current ratio and debt to equity ratio. These are two very important balance sheet measures. All right, now starting with current ratio. Now, just on an overall basis of the balance sheet of these tech companies, they tend to be very good. Their balance sheets tend to be very good because these companies, they operate in a very asset-light, cash-heavy industry. What that means is that they do not need to buy heavy manufacturing or production machinery or equipment. The equipment they need is maybe data centers, spending on data centers, headquarters, other support and network infrastructure to support the users on its platform and to maintain and improve its platform. So yes, they do spend on assets, but it's not heavy assets. It's very specialized, still very expensive assets, but it is not those heavy machinery. So they tend to be asset light but cash heavy. So what that means is that they don't need to take out that much debt, and they tend to have large amounts of cash, which drives, and we will see the ratio as we analyze, which drives the good performance of its financial position. So the current ratio of Meta. Now, the current ratio, as a simple example that I can give, current ratio is basically how much current liquid assets do you have compared to short-term current liabilities. So it's basically short-term assets to short-term liabilities. So for each short-term liability, how much short-term assets do you have? Give you to simplify it, you can think of it as an individual. Things such as your credit card debt. Maybe you owe somebody money, you have to pay them quite quickly, so maybe within the next 30 to 90 days. That is short-term debt for an individual. For companies, however, short-term debt is within 12 months. So for us, for individuals, it would be within 90 days, within 60 days. That's basically our short-term debt was. Now, so for your credit card debt, when you owe somebody all those short-term liabilities of that nature, how much liquid assets do you have? Now, liquid assets could be short-term fixed deposits, actual cash, other short-term market securities that you have. So, other short-term securities that you have. How much of that do you have relative to your liabilities? Now, Meta. Oh my goodness. Well, that's a dollar into the mispronunciation job. Meta in 2020 had 5 liquid assets for each liquid liability. So there are 5 times the liquid assets of their liabilities, which is very good. So they can pay their short-term liabilities, their current liabilities, 5 times over. That is wickedly good. Slight decrease in 2019, but heavy improvement in 2020. On average, it's sitting at about over 5.5. This is a very, very, very good ratio, and is driven mainly by the heavy mountain truckloads of cash on the balance sheet of this company. This is very, very good by Meta. This shows me that it is a very liquid company. It means it has enough cash, enough short-term liquid assets cover their liabilities on average 5 times over. 2020, 5 times over. Debt to equity tells me the long-term financial position or financial health of the company. So it's basically how much is debt as a percentage of equity. So how much debt do you hold relative to your net worth? Meta on average holds 24%, 2020 is also 24%. So it holds 24% debt relative to its net worth. So 24% of its net worth is attributable to very, very, very good. A normal ratio, normally, it will be 1 to 1. Um, However, at 24, so it's 1 to 1, meaning 100% for each. So basically $1 for $1 of debt for $1 of your net worth. Facebook holds 24 cents of debt relative to $1 of its net worth. So it's very good. This is very, very good. A current ratio, just going back there, a normal current ratio would be on a basis of um, 1 to 2. So for each liability of 1 to 2. So for each liability you hold, also for each liability you hold, my vocabulary is leaving me today. So for each liability you hold 2 assets. And Facebook is a fact. Meta is a fact. Goodness, it's gonna take me a while to get used to this whole meta thing. Sorry for that. So that's another dollar into the mispronunciation job. So 5 for Meta. So this is a very, 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 very good in terms of financial position, these two ratios. What they tell me is that not only is Meta liquid in reference to its current ratio, but it has a strong financial position, does not hold that much debt, so it does not have a lot of credit risk on its balance sheet. Very good as an investor. So you're basically buying a company that has a lot of cash, that's very liquid, and holds very low debt. So very low financial risk, very low risk for you as the investor. Okay, so financial position, a big tick mark there. I love it. Now we go to the liquidity. So the cash, so they're basically the cash ratios, the cash position of the company. I'll get more detail into that, what that means. Cash from operating margins. Now what this means is the net cash from operating activities as a percentage of revenue. Meaning for each dollar of revenue Facebook generates, so that's my revenue, how much of that can it convert to actual cash from operations? 45% or 45 cents. That's in 2020. On average, it's about 50 cents or 50%. Now that is very good. That is wickedly good. That is way too good. Again, these companies do operate in a very high margin industry that is very cash heavy. So this does make sense, but it is still very, very good. Again, as an investor, you're looking at this and saying, I'm buying a very cash rich company. So at 45% or 45 cents per dollar of revenue is very good. Now, slight deterioration from 52, 51 to 45. Slight deterioration, but as we know, as we talked about with the profitability, Facebook has been increasing its cost, or it has been still spending a significant, even though some costs are still spending a significant amount of cash on them, and there are certain costs that are increased. So you don't mind to see a slight deterioration as long as it can be justified. Now, can those deterioration in the cash from operations margin be justified? Yeah, in a way it can, because you look at the sufficiency of cash flow. Now this is basically, does the entity generate sufficient cash flow from operations to pay um, your lenders, so your borrowers, people who lend you money, to buy assets and other investing activities, as well as to reward shareholders, so paying shareholders back in the form of dividends or buybacks? And the answer is yes, still can. So slight deterioration, but you can live with that. It is justified by the fact that there has been an increase in costs. Those that are decreased are still quite significant, but all these increases in costs are justified because my revenues are growing, my income is growing, my margins are pretty strong. I still have a sufficiency. I still have a cash margin that's well on average 50% or 50%. So that means half of all revenue I generate actually into cash, which is very, very good from operations. So what this tells me that Facebook's operations are very strong. Not only can they generate cash, but they have enough cash to pay to pay and basically cover all operations, including paying lenders, rewarding shareholders, as well as buying assets and investing cash to grow the company into the future. So again, what this tells me is that the company is very liquid. Its operations generate cash and has enough cash to cover all operations to sustain and grow the entity. So again, a very big tick mark there. The dividend yield or the buyback yield. Now, these tech companies, these social media ad-based platform companies, it's very common for them not to pay dividends but to do buybacks. Makes sense considering that their share makes sense because they trade at very ridiculous multiples. So their share prices are very, very high. So a better return on shareholder investment is probably buyback rather than dividends. So it will explain this is not a yield, this is not a dividend yield, but a buyback yield. So buybacks as a percentage of net cash from operations. So of the cash you generate from operations, how much of that are you paying in dividends? 44% up to 16%. Decreasing rate, but you do expect that. Because there are instances where the company just wants to retain a bit of money to be able to fund operations. I do not mind the decrease, jumped a bit from 2019 to 2020. I do not mind the decrease considering how good uh, the cash generation abilities has been. So Facebook, in my view, has been very efficient with the utilization of cash. I love it. I love it very much. On average, about 24%, the buyback yield. Now, this is very important, basically to give an indication of how well a company is using its cash, but also when you compare it to other companies. So I'm buying a company that generates or that pays me on average 24% yield, and you can compare it to another company, and you can just so it's basically a good comparison tool. It has a lot of value when you compare it to other companies. It gives you a bigger picture. So we'll come back to this ratio a bit later. It just has more value. You can extract more value from this ratio by comparing it to other companies. A P ratio of 27%. Now, P ratio is the price multiple. So, P ratio tells you how expensive is a stock. So, how much are you paying for earnings? So, for $1 of earnings, how much are you paying? 27 times. You're paying 27 times per $1 of earnings. You're paying $27 for each dollar of earnings. Quite expensive. Quite expensive. So that is how you determine if a stock is cheap or not cheap. You consider the price multiple, which is basically one leg. Because remember, the other leg is this analysis that we did. Profitability, financial performance, liquidity in terms of cash flow generation, return that it gives you, the yield. Those are the other legs. So this is just another leg that tells you how expensive is a stock. So relative to its performance, this is how expensive Facebook. This is how much you're paying for earnings. So again, you can extract more value from the PE ratio when compared to another company's PE ratio to determine how expensive is it. So you first determine how expensive is relative to its performance. At 27, for me, it is a bit expensive, but you consider the fact that companies in this industry are trading at crazy multiples, and the fact that Facebook is a company that gives you $86 billion of revenue, 22% revenue growth, 17% net income growth, a 39% multiple, strong liquidity of 5 to 1. So you've got very, very, very a lot of current and liquid assets. You only have 24% of your net worth tied up in debt. 45% cash margin, and a sufficiency of cash flow of 1.35. Just to go by sufficiency of cash flow, 1.35, a good ratio should be 1 because it tells you you have just enough to cover all your to cover money needed to pay lenders, invest, as well as reward shareholders. So anything above 1 is wickedly good. So I'm paying 27 for all of that. And of course, very, very important, I'm paying for the fact that the company is very efficient in using its cash resources. It's really, really good and rewarding me with 16% of returns, of cash returns. So is 27 a lot? Again, for me, it's not. It's not a lot. It's pretty, it's pretty fair. It's a pretty fair price considering how much I'm paying, considering what I'm getting for what I'm paying. All right. Now I'm gonna have to compare it to other companies, and that will come at the end to justify any investment we might make. So just to recap quickly about Meta. Meta has very healthy margins. It has very, very healthy margins. It's very healthy in terms of its profitability performance. Good cost control, not spending just for the sake of spending. All costs increases are justified because they're leading to increased revenue as well as net income. Margins are fairly stable. Good return on equity above market returns, the S&P 500. Strong balance sheet, very, very strong balance sheet with low debt and a lot of cash. It can generate cash from its operations. It's shown me that. On top of that, it does have enough cash to fund all operations of the business. Gives me a 16% yield at what I would consider is a very cheap price of 27 multiple. All right. So Meta for me, it ticks all the boxes. I'm really, really, really in love with this company. It gets an 8 from me. All right. Now we're done with Meta. Quick look at how it just performed over the past year. I mean, it's performed really well. My goodness gracious. I mean, 33% returns for the past year. It's performed really well. Now, even though it did stumble a bit, I mean, this is that point I'm talking about, and that point is due to the fact that Meta went through what I would consider as a donkey excrement show in terms of regulatory scrutiny. When it was discovered that it's not good for teenage girls, it really tanked a bit. However, even though it tanked, that tanking for me was more of moral objection to the fact that the platform is not good for humans. So I want to watch my words very carefully because I'm sure a lot of people will consider me as very immoral. But here's the thing, all right? Even though those reports came out, it went through that donkey excrement of a show, of a horror show fest. The excrement did hit the fan. But, but, it's still a good company. It didn't lose any it didn't lose any users. I mean, how many people do you know after discovering the fact that Facebook and Instagram are not really good for teenage girls? How many people deleted their their Meta platform? Not a lot. So this is just moral outrage rather than financial outrage. From a financial point of view, from a growth point of view, from a future sustainability and progression point of view, Meta is still a good investment. Okay, now please take note of the disclaimer there. Now, we're done with Meta. Still a very good company. I like it. does have a bit of regulatory issues, but not enough, in my view, to derail its progression and growth. Now with Meta, we're done.